Well, welcome and good morning to our 18th annual Market Outlook hosted by Bender Commercial Real Estate Services. I'm Michael Bender, one of the partners here at Bender Commercial, and I appreciate you all being here. It's a very cold morning, and this show is a testimony really to our business community that you're willing to come out and hear what's going to happen in 2015 so that you can use it to the benefit of your business and your employees. So we thank you for being here this morning. I do want to thank Kello TV. They're our media partner this year, and they've done a great job of promoting this event for us. They're live streaming it right now as we speak. And certainly if you want to go back and see the live stream, you can do that on Kello's website, kelloland.com, or you can do it, there'll be a link on our site as well at benderco.com. So feel free to do that. And then I'll mention it now, and I'll mention it at the end. Don't forget to pick up one of the boxes out there. That's a Bluetooth speaker, a complimentary Bluetooth speaker. And then also in there is the presentation today burnt on a flash drive. So don't hesitate to grab one of those if you haven't already. Well, as we always do for 18 years now, we like to start out with a macro look at the Sioux Falls economy and see how it impacts all of the other segments. Now this year I added a couple slides on a global perspective as well as a number of slides on a U.S. perspective, and I wanted to show some concerns that I believe are starting to show up on the U.S. side. So with that, once I'm finished with the macro, then all 5 of my business partners that you're going to hear from here are going to get up and talk about land, investments, office, retail, and industrial, and the impact of the economy in relation to those property types going into 2015. So that's kind of a setup for what we're going to do today. So with that, I'm going to just go right into my part of the presentation. And I want to start with the global outlook. You can see a number of issues that are out there that are really starting to get kind of shaky. Certainly China, which has been the darling of the global economy, no question, with 10 to 12% GDP growth the last decade, is starting to slow down. Now they're only at 5%, and of course 5% GDP for China, that would be the envy of any industrialized nation. U.S., for instance, was about 2.6%, 2.7%, somewhere in that range. I think most economists would like to see that around 3.5% for the U.S. GDP. But China's slowing down, no question about it. And you can feel that throughout the global economy, and you only have to look to oil, the price of crude, to see that impact that China's had. China's only 1/5 of the U.S. economy, but psychologically, I think it's about equal as far as the feel to the investor world and the economic world. So demographics in Japan are challenging. We're probably in the 3rd decade of dwindling population growth, and so Japan clearly is not going anywhere from an economic standpoint, and they're a challenge. The area I want to focus on is the Eurozone. As you know, just recently Greece elected a leftist government. They came in and they were just taught a lesson in economics by the Germans in the last week, I think. And the Germans gave them a 4-month extension on their austerity debt reduction program. So that's really, they are going to be in the news, in and out of the news. And Greece is a disaster right now. 40% of their population aren't paying personal income tax. They just refuse to do it, and nobody seems to worry. So, I mean, there's some issues there. But more importantly to Greece is really the other southern European countries, because from a debt to GDP level, Italy, Spain, Portugal are right behind Greece. And so if where Greece goes, you're going to see a continuum of issues with the Eurozone. And of course, the Eurozone being one of the largest economic zones in the world, it's going to have far-reaching impacts on a global economy. Brazil has had record growth the last 10 or 15 years down in South America, and they are fighting off rampant inflation right now, historically high inflation as we speak. Their central government just raised their interest rates in an effort to ward off that inflation to no avail. they've raised them up to about 12.75%. So just to give you a perspective where we are and where they are, their economy is just continuing to fall because of this inflation problem. And I left Russia at the end for a reason, because Russia, as you know, is described as the Great Bear. And who knows what the Great Bear will do, so to speak, when backed into a corner. And the Russian economy, if you don't know, is 45% of the federal funds to the Russian economy are from the petrodollar, or the petro-ruble, as the case may be. So you can see that a precipitous drop in the price of crude, what it can do and an impact on that economy. In fact, it's been estimated that every 6 months that the price of crude stays in the current levels, in that $50, maybe $60 a barrel per barrel, every 6 months, the Russian economy will contract by 4.5% to 5%. So you can see that even in a short period of time, within 12 months, what that will do, social unrest, who knows what Russia is going to look like and what's going to happen. Now, I left the last thing I introduced to you is the black swan theory. I'm not sure if you're familiar with that phrase. It was a popular book written not too long ago by a Wall Street trader. And a lot of times it's referred to in the economic sense. It certainly is a broader reach than that. And it's basically a series of unforeseen and hard to predict events that coalesce at the same time, at the same moment on the world stage, and have a far-reaching impact to the world stage. I'm using it in phrases or in terms of the economic black swan. You certainly can use it for other things, but my point is could one of these countries be part of that next black swan event? Could it be a combination of some other things? So from a global perspective, it looks really scary out there. And on that rosy note, we'll turn our attentions to the U.S. economy. The dollar is getting stronger and stronger, as you know. The dollar index, which is a major index that tracks the U.S. dollar against 6 major foreign currencies, is up 15% just in the last 6 months. And you can see it's just going to continue to go up and get stronger. Well, why is that? Why is the dollar getting stronger? Well, I believe it's a couple things. First of all, our economy is getting stronger. Just plain and simple, it is getting better. It may not feel that way necessarily, but the numbers are telling you that it's getting better. And as our GDP goes up and our unemployment goes down, the Federal Reserve will, and they've started to indicate that, will at some point begin probably the raising of interest rates on the short-term level. And once you see that raising of rates, you're going to see a flight to safety by foreign investors, both into our currency and into U.S. bonds. And so don't be surprised to see the dollar continue to strengthen over the next 6 to 12 months. Now, there's a downside, of course, to the strengthening of the dollar, and that is our exports get more expensive. And while I'm not as concerned for GM or Ford or even Caterpillar for that matter, that their exports are more expensive, I am concerned about agricultural exports. I'm concerned about Raven and their exports. I'm concerned about small grain exports. And what impact will the stronger dollar have to our local economy? So it's something to think about and be watching and paying attention to over the next year, because strong dollar doesn't necessarily mean strong everything. So just keep that in mind as you go forward. Finally, I want to also focus on the deficit. You can see those numbers and a dramatic decrease in the deficit the last 4 or 5 years. Now, this isn't a decrease in spending, I might add. This is an increase in revenues. So there's another indication that our economy is stronger, there's more tax revenues coming in, and we've dropped our deficit now. Now, you don't hear this on Fox News every night, do you? But our deficit at about $500 billion, it's easy to say, I guess, but around $500 billion a year, it's about 2.8 to 3% of our total GDP, which is our 40-year historic average. So we're running deficit spending now at the same level we have for 40 years consistently, and yet you don't hear that really. So that's another indication that our economy is starting to come back. Well, let's look at some more good news. As I alluded to, the price of oil. Clearly, we're going to see the price of oil down. It's a supply issue more than a demand issue, but we're going to see the price of oil remain down probably through the balance of this year. I put this slide in relation to the consumer because I think it's important to figure it out from a consumer standpoint, and I call it a dividend. The average American spends 7.4% of their total cost of living on transportation costs. So if you see a drop, as we have in the price of crude, a dividend, and that dividend, by the way, is estimated to be $240 to $250 billion at the current level of the price of crude. So when you see a drop like that, and a savings, if you will, it'll be interesting to see what impact that has in our economy. So don't be surprised to see consumer spending up, and as well as some of these other things that are estimated what we're going to do with it. Now, sometimes what's good for the consumer isn't always good for the economy, though. Clearly, more consumer spending would be good. But in the last 3 weeks alone, oil field services companies like Schlumberger, Halliburton, and others have announced domestic job cuts of 20,000 jobs just in the last 3 weeks alone. So I would not want to be in the Bakken right now. And I certainly wouldn't want to be up there with a brand new apartment or hotel or something. And I hope the lenders in the room aren't in the Bakken right now either, because that could be trouble coming into the next couple years, because they've been building projects at a much higher construction rate, at a much larger amount, and the debt levels are a lot higher. So I foresee some real serious troubles up there. But it's all based on this supply of oil on a global stage. It's out of their hands. And it's no different than it is down in Texas. The Eagle Ford Shale Basin down there is in the same position as the Bakken is up in North Dakota. Let's look at some more good news. Unemployment growth. U.S. employment growth as a terms of percentage is up 2.1%. You can see that's the highest it's been in the last 10 years. Record number of employment growth in the U.S. economy. Let's take a look at it now in relation to both the Sioux Falls and the state of South Dakota employment growth. And you can see the yellow line there represents Sioux Falls economy, and they topped out at 1.2% employment growth. The state of South Dakota was only 0.8% employment growth. So the U.S. economy has now surpassed our local economy and employment growth. And you can see that's generally a first for quite a long time for that to happen. That's great news for the U.S. economy. But there is a silver lining in that news. What kind of jobs are we creating in that employment growth? Many of them are part-time, and many of them are very low-paying jobs. I like this slide because what it does is I want to introduce to you, you've heard about wage stagnation, you've heard about income inequality. That's going to clearly be a big issue going forward in our political discussions, and certainly a big issue going forward in our economy from a national perspective. But I like this slide because what it does is it shows you productivity of the American worker, which is on the left-hand column, and that's basically number of hours worked by GDP. And you can see a very nice steady line of productivity starting really in about the 70s. It really started going up, and certainly the last 10 years, really strong productivity growth by the American worker. And of course, the blue line is real hourly wages, and of course, those are wages adjusted by inflation. And you can see the delta or the gap that is beginning to emerge and has strongly emerged the last 5 to 10 years with wages on a national perspective. In fact, that delta right now is 48, almost 50% difference from the productivity to what they're getting paid. So let's see some more reasons why we're seeing such wage stagnation in our country. It really affects purchasing power, no question. You know, if you went back to that chart, the last 5 to 7 years is where really the majority of that compression took place from the Great Recession. And what you're seeing is you're just seeing employers reluctant to raise wages, and employees are just glad they had a job, quite frankly, the last 4 or 5 years. And so that compression has gotten even more so. Really a pent-up wage deflation, if you will, has taken place in our country over the last 5 to 7 years, and quite dramatic. Now let's look at it from a little slightly different angle, and let's look at personal income. Now, personal income is wages, but it also includes dividends, royalties, so it's other income to the person, if you will. This is the U.S. chart, and you can see here 2014, which is the very last column over here, we had about 2% personal income growth in the average American. Now, we had about 1%, not quite 1% inflation. So we really had 1% growth in personal income last year across the United States. Again, I want to look at it in relation to Sioux Falls and the state. And you can see here that Sioux Falls, our MSA, has a very nice growth corridor on personal income. They topped out about 3.4% last year. State of South Dakota topped out in personal income at about 2.5%. So well ahead of the U.S. Well, why is that? Why are we doing better than the rest of the economy? Now remember, Sioux Falls doesn't include ag income. State does. State of South Dakota does. But for the most part, Sioux Falls is immune to the ag bump, if you will. Well, I believe the reason why we in the state and at the local level are doing such a good job in keeping ahead of this stagnation is, the governor, for instance, announced another private-public partnership, $50 million in job training, technical job training, so that we can create good-paying jobs. And certainly right here in Sioux Falls, no question that Forward Sioux Falls has been a widely successful program for the last 25 years in not only identifying new jobs, but identifying good-paying jobs and creating an environment for that. So the point here is we got to put the pressure, keep the pressure on, put the foot on the accelerator. We've got to be diligent about this issue going forward. Well, what are some other solutions to that? I mean, if we could wave a magic wand and restore full employment, that would help. No question about it. Interest rates hopefully don't go up until such time as we replace some of that employment. It's a dirty word, but public investment. We probably don't do a very good job at that at a national level, but certainly right here in Sioux Falls, we do a very good job at that. The Event Center is a perfect example where it was a public investment. It created jobs to build it, but more importantly, it's creating future jobs with tourism, clean jobs, if you will, going forward. So we get it here. We've got to keep the pressure on at a local level, though, as we go forward. At the risk of sounding way too simplistic of a very complex issue, and certainly at the risk of sounding overdramatic, I believe that wage stagnation, if not addressed by the federal policy successfully, will in fact, in the next 25 to 30 years, become a direct threat to our republic. I think it's that serious of an issue, and I think we get it in this room, but we can influence others, and I think it's beholden upon us to make sure we recognize that, because there is a growing gap, and that is going to create social unrest. And if we think we're immune to it, think again. So enough of my preaching about wage stagnation, and we'll move on to the even rosier picture, which is the U.S. economy, or the Sioux Falls economy. So I showed you this slide earlier, and it was in terms of percentage growth, the 1.2% Sioux Falls growth. This is the raw data now. This is 1,800 new jobs. I've seen figures between 1,800 and 2,000. So somewhere in that range are the number of jobs our economy created last year. I believe the city of Sioux Falls announced recently that we had around 4,000 to 4,500 new residents, net migration in. So that's about the right ratio between job creation and residents. So that sounds about right for the population growth. We know this is a real number here. So good number, good news as we continue to grow jobs here in the Sioux Falls economy. And of course, job growth leads to building permits. And so let's dig into really where we are on construction permits. Now, you can see right over here that we topped out over 600 million last year, 619 million to be exact. Now, and that was a record. Now, if this is the first time that you heard that we did $619 million and it was a record, you've been living under a rock. Because our mayor over here and his city staff have announced that multiple times. They're very excited about that record. And they should be, because it was a record. Interesting thing to note here is the purple residential was up 28% last year in new construction, while the commercial was down 18%. So you can see generally the blue bar outpaces the purple bar in this category, and it historically does because there's larger commercial transactions usually, but that's not the case. So what will happen coming into 2015? I'll tell you that in my conclusions here in a little bit. Now, there was a lot of naysayers out there that I heard that said, yeah, the only reason why it was a record was because we had that one-time event that created all the remodeling and the hailstorm. And so we took some information from the city, and it was roughly about $69 to $70 million on the residential side. So even if you take out that one-time event, we still had the second highest construction numbers in the history of our city. And so, you know, it was a record. Any way you couch it, it was a record, and we should be very proud of that. Does that translate into 2015 and beyond? Again, I'll give you some predictions here in a sec. Well, let's look and see how we compare from a regional standpoint. I like to do this every year. We all like to compare ourselves and our community. So 619 million. Other communities, I always pick out Omaha because Omaha, their metro area is about 3.5, 4 times bigger than us. And yet we stay pretty close to Omaha in the per capita basis. So Omaha is a good barometer for us as to how we're doing. So you can see we're doing quite well against Omaha. No question about it. And then the one that really stood out to me was Fargo this last year. I don't know if you remember last year we talked about Willitson, North Dakota, because they had about 500 million. So on a per capita basis, they were huge. Well, Fargo was huge this year with over $1 billion. And my initial thought was, geez Louise, that oil money must be coming across the state, and they're just doing all kinds of crazy things in Fargo. And a little more research told me what it really was, and many of you know what it was. Sanford Hospital pulled a permit for $400 million in one permit, and they are relocating their entire infrastructure from downtown to the west side of the town. And so that's quite a bump for the Fargo economy. So nonetheless, so Sioux Falls is doing well, and we should be very proud of that. Let's take a look now at new commercial construction. So we're breaking down that 619 million just to the new construction now. And we like to look at this. The city does a great job of defining what that construction is in every year. And you can see blue is office, and historically office always leads the pack because it's predominantly financial services, medical, and those type of things. And it's actually bumped up a little bit, but not nearly where its historic highs have been. The one that you can see a precipitous drop is other, and of course that is our event center. You can see 11 and 12 and part of 13 was quite high, but now it's starting to come back down to, you know, historic levels. The one that I stood up here last year and talked about, and I quite frankly missed, was retail. I said that we'd see an increase in retail last year, and in reality we saw a decrease. So you're going to hear from Reggie later on and hear kind of why that happened and what's going to happen in 2015 on retail construction. Well, some examples of new construction and addition remodel here. One that you won't see on there is the Walmart on 85th and 85th and Minnesota. We expect that to be pulled this year, but it's not on there right now, so that's going to be a nice bump for this year's construction numbers. But lots of different things we've been spending money on improving, some public, some private. And finally, for some predictions for my report, before we get into the other categories. I am not smart enough, or maybe just not dumb enough, to try to predict on a global perspective. And quite frankly, I'll leave the national predictions to the economists that are in the room, because there are a few here, so I'm a little intimidated sitting up here talking about this stuff in front of them. But nonetheless, Sioux Falls, I'm really comfortable saying we're going to see positive job growth again in that 1,800 to 2,000 jobs. That's about 1% to 1.2% this year. Where those jobs are going to be, they're going to be in retail. Clearly, you're going to hear about retail growth. And they're going to be probably still in IT, the medical records. With our big systems here, there's still a lot of growth in that area. So look for job growth in those corridors. Construction, we are predicting that retail is going to be up fairly dramatically this year. Office, you're going to hear from Andy in a little bit, and it's been pretty stable. Doug's going to kind of bat at the end for us, and you're going to hear about industrial, and it potentially could be up. And then really construction on the residential side, I think, is what's important to note here. And after a couple of record years in the multifamily sector, I think there's going to be a breather on large projects. So we probably won't see quite the construction we've seen in multifamily, although the vacancy rates haven't ticked up as much as we thought they would by this time. And then single family actually took a dip down the last couple years. It's dropped down, and so I think you're going to see pretty consistent single family, not certainly a drop, but fairly consistent single family construction going into 2015. It's so early, it's really hard to tell on some of these things, but just based on what we're hearing and seeing, this gives you kind of a snapshot for 2015. So with that, I'm going to conclude my part of the presentation, and I'm going to have Rob come up, and he's going to start on the land market. So thank you very much.
Thanks, Michael. Well, as Michael had indicated in the beginning of his presentation, we decided to start this year off talking about the ground and working our way up from there. So in my report today, I'm going to be highlighting some of the trends that took place in both the unimproved and improved land markets. Now, before I do that, I first want to define what I mean by the land market. And for some of you, you've been here in the past, you've heard this presentation. Please bear with me on this next slide. It can be a little redundant. By our definition, the land sales market consists of 5 different property types. It all starts out as unimproved ground, which is generally the farm ground that surrounds the city and is sold on a per acre basis. Now, when you start plugging in all the different utilities and infrastructure such as curb, gutter, sewer, water, etc., it becomes improved ground, which is used for the 4 other basic property types. That's sold on a per square foot basis. So to start out, I just want to take a quick moment and look at my report card from last year. I'd predicted that we would see an increase in unimproved land sales, that improved land sales would remain steady, and that pricing across all sectors of the market would increase. So let's see how I did. We'll start with the unimproved land market. Instead of going up like I had predicted, there was a drop in 2014. There was 5 total transactions. Nothing to be too concerned about. It's still the second highest that we've seen since pre-recession. Of those 5 transactions, 4 of them were for residential developments. All on the east side of town, selling between $26,000 and $59,000 an acre. The 5th sale was for a mixed-use development on the south end of town that sold for right around $55,000 an acre. Now, it's important to note that all the 2014 transactions, everything in those blue boxes, 2013 and 2012, the red and purple upside-down triangles there, all those transactions have occurred on the south and east side of town. And if you remember, a couple years ago, the city put a new east side sanitary sewer system in, And if you look at those sales, they almost mirror the location of that new Eastside Sanitary Sewer. Pretty interesting. But this slide makes it pretty clear where developers have been positioning themselves for the next 5 to 10 years of growth here in town. And quite honestly, they're the ones that drive the whole entire unimproved land market. What they do is they go out, purchase a piece of unimproved land, a large land tract. They put together a preliminary and final development plan. Then they convert that. They go out and they put some infrastructure in. And then you have a build-ready lot, or build-ready lots. And in 2014, and I should probably back up, what is a build-ready lot? For some of you that don't know, you go out, you buy a lot tomorrow and start building on it the very next day. So in 2014, Sioux Falls had a supply of right around 2,900 build-ready lots. Now, when you compare those 2,900 available lots with the 835 building permits, that blue bar that were issued this past year, we're sitting on about a 3.5-year supply. And I'll tell you in a little bit here where I think the unimproved land market is headed. Let's shift gears and take a look at the per square foot stuff. In 2014, the total number of improved land transactions increased by 15%, from 54 up to 62. Now that equated to just under $30 million in total dollars spent, about a $9 million drop. Why did we see this drop, you might ask? Well, we didn't have all those retailers out there this past year buying up all that expensive land as we had seen in 13, and that is clearly shown on this next slide. In 2014, the retail land market, that green bar, had a 30% drop. Although it's interesting to note that even though every other sector of the market had increased in its number of transactions, retail still came out on top. And if you happen to be with us last year, I had actually made the prediction that we would see this drop in the retail land market as construction would try to catch up with all of those 2013 transactions. So let's take a look at the going price for each one of these sectors of the market. The largest spread when it comes to pricing is in the office and retail markets, and that's primarily because they're much more location sensitive than that of the industrial and multifamily markets. I would like to point out that the largest increase we saw in pricing this past year was in the industrial market. We had a 10% increase. So that was pretty interesting. I would like to highlight something, an interesting trend that we saw last year that converted over this year, and that was the addition of infill sites. This is the second straight year that we saw infill sites. And these are generally those sites where the land itself is more valuable than the structure that sits upon it. And what you get is you'll have owner-occupants or investors stepping out and purchasing these properties with the intention of redeveloping these sites for a higher and better use. And oftentimes they're willing to pay a premium for it, anywhere from $15 to $35 a square foot. Now this past year we didn't see any $30 to $35 a square foot sales. We did see some in the 15 to 20 range. And some of those examples included the old Hoy Law Office up off of Russell, an old bank site. That's going to be used for a mixed-use development. That'll house a new mixed-use development. The second one is on South Minnesota Avenue. There was an old house or office house or whatever you want to call it that got raised and converted to a parking lot right next to Subway there. And then the third was downtown, right across from Sunshine Foods. A local developer went and purchased this piece of ground and is currently in the process of redeveloping it into luxury residential condos. So with that, I just want to jump right into my conclusions and predictions. The unimproved land market, we did see a drop. We saw 5 transactions this past year. But as some of these developers step out and continue to add to those build-ready lots, what they end up having to do is to keep that pipeline full, they got to go out and purchase more unimproved land. And this year, I think we'll see right around the same number of transactions, 5 or so. As far as the improved land market, for the past 4 years, we've seen increases anywhere from 15 to 40%. And I think we'll see another record-breaking year in 2015, right around 65 transactions. Also, keep an eye out for those infill sites. I think we'll see a third straight year of infill site purchases. And as far as pricing, the price per acre and the price per square foot that people are paying across the market continue to go up. And I think in 2015, we'll see about another 5 to 10% increase in some of the sectors that I discussed today. So, short and sweet. Feel free to come up and ask questions afterwards, but right now I'm going to introduce my partner, Reggie, to come up and talk about the retail land market.
Thanks, Rob. Well, my mom always told me to picture everybody in their underwear. And we all know that Doug's got a dramatic flair for his socks. I just didn't know, I just can't believe he bought the matching underwear. As Rob said, I'll be presenting on the retail sector today. 2014 was a year of growth. We saw rising rental rates, decreases in vacancy, faster deal acceleration, and a massive increase in sales transactions, which Nick will talk on a little bit. As Michael alluded to earlier, we were a little bit surprised about the lack of new construction, and I'll get to that in a few minutes. Retail tends to focus in clusters, generally around a landmark like the Empire Mall or along a heavily trafficked intersection. In the past, we've broken these focal points down individually and presented on them. We started looking at the numbers this year, we realized it was pretty much status quo. So instead, my report this year is going to focus a little bit more on the trends going on in retail, but we're going to take a look at the data here real quick. A couple of interesting notes here. 26 in Marion saw a spike in vacancy up to 17.5%. This was primarily due to new construction retail strip mall development in Lake Lorraine. Some of the tenants that have signed leases there were cannibalized from that intersection already, which further peaked that vacancy. That will come down in 2015. Also, take a look at a Dolly Farm area, which does include that traditionally more difficult to lease space on the north side of Arrowhead Parkway. That space, we saw some leases signed this year, and for the first time ever, we're down into the single digits at 9%. I'd look for that trend to continue with more momentum in Dolly Farm this year. So let's talk about some trends. One of those is restaurants, because who doesn't like to talk about restaurants? As you can see, this may look like the Sprint cell coverage map for the United States. It's actually a restaurant densification map per 10,000 households. Certainly the urban legend in Sioux Falls has always been that we have more restaurants per capita as anywhere in the country. But as you can see from this map, that's not quite the case. There's probably room for growth, which is exactly what we saw in 2014. Just take a virtual drive down East 10th Street with me. In the last 12 to 18 months, we've seen the following new restaurants: Qdoba, Pita Pit, Pizza Man, Macho Nacho, Lick the Spoon, Jimmy John's, Noodles, Firehouse Subs, Panera, and Panda Express. A massive increase. Also, we've heard recent discussion of a restaurant row in the city, and based upon conversations that we've had with national restaurant chains, that may be a possibility, but it's more than likely to happen at a destination like Lake Lorraine versus anywhere else in the city. Also, the minimum wage is having a direct effect on the bottom lines of these restaurants. In a recent conversation with a client with multiple locations, it was hitting the bottom line at about the tune of $1,000 per month per location, which probably means we're all paying more for food in 2015, and it remains to be seen whether that will taper some of that restaurant expansion we've seen in years past. So what does that mean for the city? Last year we saw a 6.6% increase in restaurant sales. This is primarily can be attributed to the inflation and the population growth. But at the end of the day, we have winners and losers. Who lost in 2015? Fast food lost. KFC closed the location. Long John Silver's closed the location. And we've heard recent national and global discussions of declining sales in fast food industry altogether. Don't be surprised to see another one or two of those go dark in the next 12 months. Also, the frozen yogurt fad has come and gone. Several went dark in 2014. And we have our other category, which includes La Fiesta Mexican, That's a Pizza, and IHOP. The winners, the fast casual, the QSRs, the quick service restaurants like Qdoba and Pita Pit have seemed to have flourished. Also, your health conscious and your neighborhood bars have done really well. And your unique concepts, MB Haskett, Parker's Bistro, are in that category. Let's talk about another trend, the evolution of retail. Moving forward, retail will be led by the 3 M's. It'll be mobile, metropolitan areas, and the millennial generation. Amazon is clearly driving this movement. Amazon's online sales are larger than their next 12 competitors combined, which is really impressive. The online sales of those other 12 are Walmart, Best Buy, Barnes & Noble, Staples, and 8 others. Also, Google's made a recent announcement that they're going to enhance the shopping functionality of their website in an effort to compete with Amazon, and both are toying with the idea of a 1-hour delivery service in the near future. So what does that mean for national retailers that have locations in Sioux Falls? We've already heard that Radio Shack's filed bankruptcy. 2,600 locations will be closed. 3 of those are right here in Sioux Falls. Don't be surprised to see several of these others go dark in the coming years because of the Amazon effect. Conclusions, the fundamentals were strong. We see corporate, national, franchisee interest is really strong. And construction was down, we talked about that. But when we really looked at the numbers, we didn't have the outlier. We didn't have the $5 or $8 or $10 million transaction or the building permit that were pulled, which leads right into my predictions. We do predict that the retail construction will go back up this year, primarily led by the Walmart at 85th in Minnesota, some redevelopment along 41st, new construction out at Dolly Farm, and of course, Badlands Pond. As I said on the previous slide, don't be surprised to see one of those big boxes become available. The likely candidates this year are OfficeMax, Kmart, Sears, or JCPenney. And downtown retail continues to do well as we've gotten more and more residents. So where are we at in the real estate cycle? I think it's pretty clear to everybody in the room we're in expansion, and I'd look for us to stay there in 2015. I'd now like to bring up Andy to present on the office market. Thank you.
Thanks, Reggie. I need to come clean on one thing. If any of you have gone to a 3D archery tournament, you know that they're self-scoring. So the champ title was actually given to me by my dad, so I had to just come clean on that. I am here today to talk about the office market, and fortunately for Sioux Falls, it has been consistently growing over the past several years, which is really good news. We have a total of 13.6 million square feet. Now that's inclusive of owner-occupied as well as tenant-occupied buildings. As I move forward, I only focus on the blue bar, which represents 6.9 million square feet of tenant-occupied space, due to the fact that the yellow bar, which is owner-occupied, doesn't affect our vacancy or our rental rates. We break the office market up into 2 sectors. The CBD, or the Central Business District, is the first sector I like to focus on. We did see a very slight uptick of 0.7% in its inventory, currently sitting at 2.3 million square feet. Now that increase in inventory wasn't due to new construction. However, what we saw were conversions from owner-occupied properties to now tenant-occupied properties. One example, the former Traditions building. Once owner-occupied, now a multi-tenant building. And our vacancy shot up in the CBD by 77,000 square feet. So it's no surprise our vacancy rate went up from 8.1% to now 11.9%. And in addition to that Traditions building, a couple of other contributors to that increase in vacancy were the Wells Fargo building, which shed 25,000 square feet, as well as the Pioneer building, or as I know it, the former IBM building, which is back on the market, adding 33,000 square feet. And with that increase in vacancy, it's no surprise we had a negative net absorption of 59,000 square feet in this sector. Now, downtown is really one of those sectors where 1 or 2 buildings can really affect the market, especially those with larger footprints. Now, I know this slide doesn't feel very good, but it's good to have opportunities to present to companies who are considering moving downtown. And some predictions. I predict our inventory will remain stable, and if parking requirements can be met to companies looking to move downtown, I think our absorption will only continue to increase, which will help our rental rates go up as well. Now let's take a look at the suburban sector, which is everything excluding the CBD. Last year, I predicted some speculative building in this sector, and we did see that. For example, along Western Avenue, between 69th and 77th Street, those buildings, along with others, helped to add 110,000 square feet to this sector, with a current total of 4.6 million square feet. And demand is very strong here. So we had a positive net absorption of 122,000 square feet. However, if you take a look over the past several years, we're still well below the average. What I think we're seeing in the office market is a real systematic shift taking place. Office sharing, working from home are all becoming more common practice. And when you have positive net absorption and strong demand, vacancy rates drop, and that's what we saw here. We went from 8.1% down to 7.5%. And some predictions for this sector, again, with demand being so strong, our inventory will only continue to increase. And I predict with that happening, rental rates will continue to rise as well. Now let's shift gears. We're going to take a look at things as a whole. This slide represents our citywide vacancy rate. And the blue line, which is Sioux Falls, you can see has gone up. If you remember those two buildings I talked about downtown, those two buildings really helped to push up our citywide vacancy rate, currently sitting at 9%. However, when you compare us to the national vacancy rate, which is at 17%, Sioux Falls is doing very, very well. And what I think we're seeing happen on a national level is a trend that I spoke of last year, and that's office densification taking place. More bodies and less square footage. It certainly is affecting those national markets. We're seeing it here as well, just not quite as dramatically. And our rental rates have continued to creep up. Class A rental rates are at a range from $13.50 a square foot to $17 a square foot, and these are net of all expenses. Class A over the last several years has seen a consistent increase between 6 and 8%. Class B and C, typically these are second, third generation office suites that are being presented to tenants. Owners don't have to spend quite as many dollars to improve those spaces, therefore they're able to take a little bit more of an aggressive rate. But this is still very healthy at a range from $8 a square foot to $11 a square foot. And over the past several years, we've had positive net absorption in both sectors. This year was different. If you remember, we had that large amount of negative net absorption in the CBD. When we combine that with the suburban sector, that negative really offset the positive, resulting in a much lower net absorption than what I predicted we would have. However, it is still positive, which is good news. And my citywide predictions, I predict that we'll only continue to have positive net absorption. Companies are moving to Sioux Falls, expanding in Sioux Falls, so it is a really healthy market. Again, and I predict rental rates will continue to creep up. I do think we'll keep seeing speculative building taking place. However, I do think it'll be on a limited basis. So where does that put us on the real estate cycle? For 2014, I think we are just poised for growth in the office market, and we'll just continue to stay in expansion for the next couple of years. Now I'd like to turn it over to our cigar expert, Nick Gustafson.
Thank you, Andy. I have a very serious but positive presentation, but what I can't get my mind off of after Reggie's joke is Doug's underwear. Okay, in this section of the presentation, we focus on multifamily, office, and retail to give you a flavor of 2014 deal making in both owner-occupied and investment transactions. We'll take a look at what happened in 2014, and we'll make some predictions about 2015. So let's break down multifamily first. And this bar that you see right here is new unit construction in multifamily going back to 2004. And clearly, since 2010, you can see that we have developers building an increasing number of units every year. Why are they doing this? Number one, low interest rates, continued low vacancy, and continuing population growth in Sioux Falls. Let's break out, I want to note here in townhouses is in yellow. We break this out here because most of these units are built for leasing. A fair number of them are sold as condos, so we break these out for clarity in our reporting. So next up, what we have here is vacancy. Let's talk about this. This blue line here is Sioux Falls multifamily vacancy going back to 2005. The yellow is national. Since 2011, multifamily developers are encountering increasingly low vacancy rates. The reasons for this is, number one, we have home buyers. It's just a little harder to borrow money from banks right now as a home buyer. We have changing attitudes towards home ownership, as millennials would rather lease. And again, Sioux Falls is growing, so that's great. How did this affect sales? Well, quite frankly, this blue bar right here goes back to 2005 multifamily sales. The number in the bar represents the transactions 4 units and higher. The red bar is the 10-year running average. Now, clearly, in multifamily, we're just trading sideways. Why? Number one, capital gains, depreciation, recapture, and frankly, there's nothing on the market. So if you own a property and want to trade up to do a 1031, you just really don't have any options. So multifamily owners are sitting tight and collecting checks, which is actually a pretty good place to be. Let's take a look at some specific transactions. Number one, this is a newer, larger unit. Most of the deals that happened last year in multifamily were smaller, older units. This is really the exception. $4.3 million deal, 54 units, 7.6% cap rate. Great project. Next up is one of those smaller, older properties. $1.2 million, 4 buildings, 28 units, and this traded at an 8.4% cap rate. Next up, we have a nice development here near 57th and Cliff, $1.2 million, and this traded at a 6% cap rate. Sellers, don't get excited about this California cap rate. This was mainly due to high expenses on the owner's property management side. So let's talk office. Blue bar, again, just like multifamily, goes back to 2005 in dollars. The red bar is a 10-year running average. Now, we had a really good year in office. This is a third best year in Sioux Falls history, but we were really lacking a larger investment transaction like the $14 million Heather Ridge deal that we saw take place in 2013. This market was characterized by smaller owner-occupant transactions, and we had a lot of them. Let's take a look at a couple. First up, you can see here is the former DocuTap headquarters. This was purchased by an owner-occupant for $1.9 million, or roughly $125 a square foot. Next, we had a dentist buy a 12,000 square foot building, $1.34 million. The dentist is renovating and plans to occupy the 5,000 square foot vacancy in the front of this building. Next up, we have office, one of the few office investment deals that we did see last year, $1 million deal, $100 a square foot, and this traded at an 8.7% cap rate. So let's talk retail. Retail clearly had an amazing year last year. We saw a lot of transactions in investment, owner-occupied deals, and it was just phenomenal. The red bar here is a 10-year average, and we almost doubled that. Amazing. The story here is over 35% of these transactions happened on the Louise Avenue. An original developer decided to sell a couple of properties as he took profits, taking advantage of strong retail fundamentals and motivated retail buyers. Let's take a look at a couple of these. World Market Big Lots building sold for $4.55 million. This represents roughly a 7.4% cap rate. Next up is the PetSmart Dress Barn building, $7.7 million, again, roughly the same cap rate. And next up, as my 3-year-old refers to this as the Chuck E. Cheese building, $4.8 million, or a 7.6% cap rate. So how did we do last year? Well, clearly, in multifamily office, they were down. They weren't bad years necessarily. We were simply lacking a lot of deal flow. In retail, had a hands-down spectacular year. So what does that mean for this upcoming year in 2015? The exact opposite. Multifamily, we're going to see buyers get really motivated, and sellers might be getting a little nervous with rising interest rates and vacancy. Everyone's going to be eyeing that number very closely. I think we're going to see increased selling. In office, business owners are making more and more money, and they're getting increasingly optimistic. You can feel it. So look for more of these buildings to trade. In retail, we're going to have a strong year in retail, don't get me wrong, but there's just no way we're going to surpass last year's record. Cap rates. Cap rates aren't really going to change much in multifamily and retail. They're going to remain in that 7 to 8% range, and that really shouldn't surprise anyone as interest rates have maintained stability for the last couple of years. Office is going to trade in that 7 to 8.5% range. So let's take a look at the real estate cycle. All 3 asset classes I'm placing in expansion in terms of sales. And with that, I'd like to introduce my partner, Doug Brockhouse, who will finish the presentation with the industrial market.
Thank you, Nick. I want to point out, we went by that one really quick. I want to point out, there we go, thank you. That 1,300, that's not 1,300 doves. I don't want the game wardens showing up in my house tonight checking in my freezer, because I don't have 1,300 doves in my freezer. So that word is dove, and that was in a special suit and whatever. Anyway, I get to present today on the industrial market, and here comes the boring parts, the definition thing. We define the industrial market as those properties that are used for manufacturing and distribution, transportation. We throw in storage units, put in contractor shops. A lot of people say, if a magnet sticks to it, it's probably going to show up in this report. So with that said, let's move on. Okay, this year when we did our survey of the market, we saw that about a 12 building increase in the market, which added about 300,000 square feet of space. Our industrial market in the Sioux Falls area currently stands at about 15.6 million square feet, and T sitting at about 313 buildings. That market pretty much stayed stagnant. But what I want to point out, something that happened in T, is the fact that the vacancy just tumbled down there last year, and I'll explain more about that and why I think that happened later on in my report. We've always talked about the split between owner-occupied space and tenant-occupied space, and the anomaly continued again. The Sioux Falls market remains at about a 70-30 split, owner-occupied, tenant-occupied, and the tenant market is a little different at an 80-20 split. And I think that trend is going to pretty much continue, because I think that the developers and the builders out there are just going to stay away from speculative development until such time as rental rates get to a point where they can actually make money, and until then, it's going to pretty much stay stagnant. So to set my report off and tell you about how I did last year, let's take a look at the report card in the industrial market. We looked at the market January 1st, 2014, 1 year ago, and we saw that there was 536,000 feet of vacant space. Of that 15.6 million, 531,000 vacant, 3.5% vacancy. That's a really, really, really tight market. And at that period of time, the market was absorbing space at about 3,000 feet per day. That meant that 536,000, we had about 180 days supply at beginning of 2014. There's a message just popped up here. It said, don't forget to mention that the city issued a record number of building permits and dollars spent last year. Yes, that's true. But those dollars were not spent in the 12 projects that were completed in the industrial market. When we take those 12 projects that were completed in 2014 and plug them into this graph, you see that 2014, that bar is less than half as big as 2013, and it's down 50,000 feet from 2012. That's not the way the market felt. It's not what we visioned. We thought it was really a robust market, but those are the numbers. I know a number of you sitting out there today come to this presentation for one thing, to see pictures of industrial buildings. And I'm not here to take that away from you. So here you go. The building in the upper left-hand corner, that's Abilene Machine Building, a farm machinery company out of Abilene, Kansas, came to town, thought we had a great market here. They built a new facility up by the Sanford Research Center. On the other side of the interstate, Extreme Heating built a building up in the Granite Valley area. And Speedy Delivery, who used to be up in Granite Valley, they had a new building built for them over by the new Walmart in the northwest part of town. Some of those pretty industrial buildings. Another part of the market that we take a close look at is existing space turnover. We saw in 2014 that about 700,000 feet of existing space turned over. And if you take a look compared to 2013, about the same. You know, it's about the same trend. But here's the question. How many more times can we turn those buildings over and over and over again? We question how long that trend can continue. We compute available space. That's how much space, if somebody calls up and says, hey, how much space is out there? What we do, we take a look at the vacancy at the beginning of the year. To that, we add new construction. And once again, those low new construction dollars come back to haunt us. We add that to the turnover existing space. You can see that for 2014, we had about 1.4 million square feet of available space. The norm would be somewhere around 1.7, closer to 2 million square feet. So the available space number was down for 2014. At the end of the year, December 31st, once again, we canvass the market. We say, how much space is available now? And when we did that this last December, we discovered that we had moved into an area that's uncharted, less than 2% vacancy. Of that 15.6 million square feet in Sioux Falls, only 276,000 feet of that space is currently sitting vacant. So there you go. That's how tight the market is today. So some simple math, talk about what the vacancy, what was available. You can see that our net absorption last year, the market absorbed about 1.1 million square feet of space. Not a bad showing, we're still right up there. So you take a look at net absorption compared to the previous year, we're pretty much right on track. But once again, we're going to come back to the point of we're running out of available space, and we need to step up that new construction. Okay. As I mentioned at the beginning of the year, we're absorbing space at 3,000 feet per 3,000 feet per day. That trend continued the entire 2014. Every single day, 3,000 feet got absorbed approximately. So by the end of the year, like I just said, 276,000 square feet. If nothing else enters the market, nothing else gets added, and there will be. High Rollers is building a new building in the north part of the city. Their current facility, actually, I saw the data sheet come out this morning, so that space will come on the market. National Republic, a booze warehouse that's up in the Airport Industrial Park. They'll be breaking ground here shortly, and their facility will hit the market with an availability of Q1 2016. Putting those aside, that 276,000 square feet at a 3,000 foot per day absorption, we're out of space by the 4th of July. Okay, let's take a look at some of the transactions that made up that net absorption for the year, some sales and some leases. This is a picture of another one of those pretty industrial buildings. Actually, there's a pair of these that sat there. This was really an investment sale. Both buildings were filled. Properties that were owned by the Natchez estate. This particular sale was below the average we saw last year. And the reason why we saw it below the average, we feel that the length of the leases were short and the rental rate being paid was below average. Therefore, the amount of money that was paid for those properties as an investment was down. It's a picture of the former Speedy Delivery. I mentioned that they had a new building built for them. This is the Speedy Delivery building. It's up in Granite Valley. After extensive remodel, it is now a brewery. You might have heard recently that they'll be having an open house. Looking forward to that. We'll have a new brewery on the north end of town. Cool. This is a picture of a building up in the Merle Roy Park, Benson Road and I-229 area. The people that bought this property were willing to pay a little bit more than average because the building fit their needs. So they didn't have to put a lot of remodel dollars into it. So it's a little above average. There were 42 industrial building sales last year, and those sales range from 12 something a foot up to about $100 a foot. Now, if we take those outliers and take those out of the equation, the average price paid last year was around $42 a foot. $38 the previous year. That number is up about 10%. Why? Because there's a lack of supply and demand. People want to come to town, they're going to pay more money. There you go. So here's some industrial lease intel. The truck repair leasing company that occupies this building on North Jessica Avenue renewed their lease 6 years. They came right in at average price of about $5 a square foot with that renewal. The company that went into this little building on North Casco Avenue paid a little over average price, and probably because there was an extensive office in this particular place. Plus, we have a landlord in this case that's really a tough negotiator and just isn't going to take a lower rental rate. This is a bar graph of rental rates over the last 14 years. And there's really two takeaways from this bar graph. First off, the attacks that occurred back in 2001 and the economic collapse that happened in 2007 and 8 drove down industrial rental rates by about $1 to $1.25. And it takes a long, long time to recover from when we lose that $1.25. The other takeaway is that $5 bar you see to the right. Looks like the highest amount we've ever seen. It's true, but it still remains a roadblock. And let me explain why I feel that way. That $5 rental rate, yes, that's a net amount. That means the tenant pays the real estate taxes, they pay the insurance in the building, and they pay for some of the maintenance. But still, the landlord, or the owner of the property, has to put away some money for replacement costs. They have to take care of replacing the parking lot. It's called a sinking fund. They have professional fees and management fees, and my favorite, commissions. So when they get done overpaying our company, Mike always says we get overpaid one time, and that's when we sign the lease. The rest of the time, we're kind of working for free. But we end up with $4. The investor ends up with $4 in their pocket. Now, if a person's looking to make an 8% return, that $4 means that all in construction, land, everything, that you can spend $50 on a property. That's just not going to happen. You can't do it for $50. Andy keeps saying, okay, Doug, if they can't do it for $50 and $5 doesn't work, what's the number? I feel it's about $6.50 to $7 is the rental rate net that we have to achieve. If we get to that point, then you'll start seeing a bunch of speculative industrial building and things will start happening here in Sioux Falls. I mentioned a drastic drop in vacancy in the T market. Why did that happen? Because T had capacity. There were vacant buildings down there. Those buildings got absorbed. That didn't happen just in T. It happened in Hartford and Humboldt and as far south as Canton. Where there was capacity, companies went there. Yes, a travel distance to Sioux Falls because a lot of them service Sioux Falls, but they're willing to drive that because that's where there were available buildings. Okay, let's jump into my conclusion and predictions. That trend with those surrounding communities and the areas around Sioux Falls, I think that continuous growth or transactions happening in those communities will continue. And here's why I think that's going to happen. I mentioned a $50 all-in cost. Of that $50 all-in cost, 25 or 30% of that number is the cost of the land. Some communities, we're doing a deal right now up in Watertown, they charge $30,000 an acre. Here in Sioux Falls, it's $2.50 a foot. Some of those communities are willing to sell their land really, really, really cheap, and some of them are willing to give away their land to attract industrial users. And it's tough to compete with free. So another conclusion, the lack of construction we saw in 2015, even though it's pretty darn cold out today, you're already seeing construction going on, and I think we'll see an uptick in construction for 2015. Another thing that's happening is our phones are ringing. We're getting a number of phone calls. Kind of feels like 2006, 2007. People are saying, hey, send me all your data sheets on the 70, 80, 90, 100,000 square foot buildings. We have companies that want to take a look at the Sioux Falls area. We don't have any of those right now. But those are the phone calls we're getting. I think there's some movement right now to try. I think the Development Foundation is working on trying to get some land so we can provide those things. So that's going to. So here's my challenge for 2015 and 2016. I don't know if it's going to be the Development Foundation. I don't know if it's GOED. I don't know if it's SBA. I don't know if it's banks. I don't know if it's private investors. Not sure who it's going to be or a combination thereof. But we got to figure out a way to offset that 25% difference between those outlying communities' land and Sioux Falls. We got to figure out a way to bridge that, to get more of those companies to come back and look more at Sioux Falls over here and start doing their thing here in Sioux Falls. That's the challenge. We need to figure out a way to get them to come here. There's the challenge. Okay. I was going to point clear over to the far side over there and talk about expansion, but I see it's over here. So, as I talked about, decreasing our vacancy, that's going on. Moderate to high new construction, missed that one. But high absorption, moderate employment growth, all the rest of them say that we're in expansion. We just got to make it economically feasible for people to do that growth here. So 15, we're in expansion mode. Thank you. Michael?
Well, there you have another market outlook, our 18th, and there's a few people I do want to thank before we get going and before I dismiss you. Certainly, I want to thank Kello TV again. Angela, thank you for your involvement, and as our media partner, they've done a great job in helping get the live feed out and promoting this, so we do appreciate that. Summer Hoffman, who is our Director of Research, I believe this is her 16th time, I'm not sure, doing this.
When you get my age, you don't count anymore.
Yeah, this is, I think, her 15th or 16th time doing the Market Outlook with us, and this is, I think she's going on vacation next week, so I want to thank her for sure. I do want to thank you. You all are our customers, our clients, our friends, and we're all in this together, so I appreciate your involvement, certainly your attendance this morning, but more importantly, your involvement in our community, in whatever factor you're involved in the community that you do. And finally, I want to thank my business partners. I get to stand up here, and my name's on the back here, and generally I get all the credit, but I've got 5 business partners here at Bender Commercial. I've got a business partner in our property management company, a business partner in our development company, and they all really set the tone for our company, and they are the embodiment of those other 30-plus individuals that work with those people. But most importantly is the gentleman right next to me, Doug Brockhouse. Doug has been at all 18 of the market outlooks, the very first one where we had 6 people around a lunch table. And he's given a report and done the research, and really Doug embodies who we are and is really the heart and soul of not only this market outlook, but our company. And so I just wanted to honor that by wearing an orange tie like you.
There you go.
And basically say thank you. I didn't get the orange socks, but say thank you for our partnership
thank you.
all these years, and I really do appreciate what you've meant to me as a friendship and as a partner. Finally, before I dismiss you, don't forget to grab one of these really cool, we think really cool, Bluetooth speakers.
Wait a minute. I thought this was a salt shaker.
Yeah.
And we want everybody to come next year and they get the pepper shaker.
Yeah. Well, that's a good idea.
If this is a speaker, how do you turn it on?
I don't know how you can charge it. Forget about turning it on.
I got a great idea. Take your little speaker home, find a kid that, and they can fire this thing up. These things are cool.
Yeah. And then inside that box is our disc that we give you every year. It's burnt on here with some voiceovers. So feel free to grab this, and feel free to take more than one if you want and give it away. It's designed to get it out there. So you are dismissed. Have a great 2015, and thanks again for being here.